Dirk Hoffmann-Becking is European banks analyst at Sanford Bernstein. Joins me in the studio now. Thank you so much for coming in.
Yeah, pleasure.
So why do you think French banks were at the heart of the bank rout that we saw yesterday?
I think it's a combination of two things. One is, the concerns about the French AAA rating, and the other side is essentially rumors which, I think are deeply unfounded. And the bank is not only denying the rumors, they're saying July and August is going all right, and that there is absolutely nothing to any of these allegations.
Yeah. Well, they've got one step further, haven't they? They've asked France's watchdog to actually look into the speculation that resulted in the steep declines that we saw yesterday. And they've bounced back a little bit, but not back to where they were. And you're saying that the sell-off is short-lived anyway. Why is that? Why are French banks resilient?
Well, I mean, in the end, if you look at the funding cost, which drives most of that, the funding cost of banks are driven by country risk and by the bank-specific issues. And if you look at, SocGen's CDS spread last night at 330 basis points, 170 of those are due to France, and the other 150, 160 basis points are due to the bank. Now, France's AAA rating, has been affirmed by 3 rating agencies. What more do you want? It's if the rating agencies say it is staying at AAA, then it probably is. And the other thing is, if you look at the connection that people make between the US and France.
Yes, that's precisely what I was going to say. That seems to have there seems to be concern about the impact of the US downgrade on Europe.
Yeah, but if you look at why was the US downgraded, it was partially about concerns about their ability to pay, but much more about concerns about their willingness to pay. If there's a significant minority in a country that says, well, we don't actually care whether we give money to our sovereign lenders, well, that basically makes a downgrade, almost inevitable. Whereas in France, there's absolutely no indication whatsoever that anybody would not want to honor their commitments. Absolutely nothing.
Okay, so Dirk, if the sell-off in SocGen wasn't justified, is the bank in a structurally better position now compared to 2008?
Massively, massively. I mean, they carry a liquidity buffer of 105 billion, and their short-term borrowing is 96 billion. So they have more liquid assets than they have short-term borrowing. On the interbank market, they're net positive, so they're lending more money into the interbank market than they borrow. So even if the interbank market freezes up, they'll actually be 17 billion in plus rather than in a loss. So, I think banks have done a huge effort in terms of improving their resilience since 2007, and I think SocGen in particular, because everybody regards it as a more vulnerable bank.
But French banks do have the largest exposure to Greek debt, don't they? How's that impacting their balance sheets, given the write-downs that we've seen in just the past few weeks?
So SocGen has 2.5 billion in government debt in Greece. They've written down 500 million this quarter. That's 20%. Nevertheless, they made a 1.6 billion profit this quarter. If they have to do this twice again, we're looking at probably another billion, then they would have written it down by 60%, which I think pretty much covers anything you could possibly want.
Okay.
And even we've done analysis on the Geniki portfolio. Even if you write that down by 30%, the net impact on Tier 1 ratio is 50 basis points. They made 57 basis points this quarter.
Okay, so then the write-downs for Greece won't make any material difference to their balance sheets, is what you're saying. I'm wondering then if banks like SocGen are tough enough to cope with the turbulence that we've seen in the markets, or indeed a freeze in short-term funding.
In the end, no bank can survive an extended and permanent liquidity freeze. But I think that, compared to, 2008, when the liquidity freeze was very prolonged and much worse, we're nowhere near that kind of liquidity freeze. Plus, the bank, as I said, is in much, much better shape than it was at the time.
And Dirk, you do make the distinction between the larger banks in Europe and the smaller banks, which are having more difficulty obtaining commercial funding, don't you? And what are the implications of this for the broader landscape of the European banking market in, say, several years from now? Are we looking at a market that is much more consolidated, much less diversified?
Yeah, absolutely. I mean, one of the effects of SIFI is that, investors will look at banks and say, well, they carry more capital, plus they have a sort of implicit guarantee, and these companies and banks will fund themselves much more cheaply than the others. And, if you have a funding differential of 50 or 100 basis points, as we currently see, that really wipes out your competitiveness if you are, one of the unlucky ones that didn't make it to the club.
All right. Well, thank you very much indeed. Great to talk to you. Dirk Hoffmann-Becking of Sanford Bernstein.